Crowd psychology is one of the most underestimated forces in personal finance. Most people believe financial outcomes are determined by income, budgeting discipline, interest rates, investment knowledge, or economic conditions. While all of these matter, they do not explain why people who earn well still struggle financially, why investors repeatedly make the same mistakes, or why entire populations shift their financial behavior at the same time. To understand these patterns, one must look beneath the numbers and into the collective psychology that guides human decision-making. Crowd psychology refers to the way individuals behave when they are influenced by the actions, beliefs, or emotional states of a larger group. It is not a conscious process. People rarely tell themselves, "I am following the crowd now." Instead, the influence operates quietly through observation, social comparison, emotional contagion, and the deep human desire to avoid isolation or regret. Financial behavior is particularly vulnerable to this force because uncertainty and risk activate emotional pathways more powerfully than rational ones. In personal finance, crowd psychology manifests in four major behaviors: herd buying, herd selling, social proof investing, and emotional synchronization. Each of these behaviors appears harmless on the surface. Each of them feels intuitive in the moment. But all four have repeatedly destroyed personal wealth across centuries, cultures, and economic systems. The danger lies not only in the actions themselves but in the illusion of safety they create. When many people make the same financial choice, it appears to be correct. When few people make a financial choice, it appears to be dangerous. And yet, the outcomes often move in the opposite direction. To understand why crowd psychology is the biggest enemy of personal finance, one must begin with the fundamental nature of human decision-making under uncertainty. When people face financial choices, whether to invest, save, buy an asset, or avoid risk, they instinctively look for signals that reduce uncertainty. One of the strongest signals is the behavior of others. If many people are buying a particular asset, it feels safer to buy it. If many people are avoiding an asset, it feels safer to avoid it. This instinct has deep evolutionary roots. In early human societies, following the group increased survival odds. But in financial environments, the instinct becomes a liability rather than an advantage. Herd buying is the most obvious and destructive form of crowd influence. It occurs when individuals rush to purchase an asset primarily because others are doing the same. This creates a chain reaction. Rising demand pushes prices upward, which attracts even more buyers who interpret the rising price as validation. At the peak of this pattern, people no longer ask fundamental questions. They no longer evaluate risk. Their decisions are driven by momentum, excitement, and the fear of missing out. Historically, herd buying has fueled every major asset bubble, from tulip bulbs to internet stocks to real estate booms. But the same pattern also appears in everyday life, such as when individuals buy products, services, or financial tools simply because they are trending. Herd selling operates through the same mechanism in reverse. When asset prices begin to fall, people observe others exiting, and emotional fear spreads quickly. Because losses activate a stronger psychological response than gains, herd selling often becomes more intense than herd buying. Individuals who resisted selling early finally capitulate when the crowd becomes scared enough. By the time the herd completes its exit, the asset has already dropped significantly. The pattern is universal: buying too late, selling too late, and allowing emotional waves to dictate financial timing. Another important element of crowd psychology in personal finance is social proof investing. Social proof refers to the tendency to adopt beliefs or actions based on what others endorse, especially when those others appear confident, successful, or numerous. In finance, social proof manifests through trends, recommendations, online opinions, peer behavior, influencer content, and mass enthusiasm. Even when individuals believe they are making independent decisions, their choices often mirror the decisions of their environment. Social proof does not rely on logic, it relies on perceived consensus. Emotional synchronization is the deeper mechanism underlying all forms of crowd influence. Human beings unconsciously match the emotional states of groups. When markets rise, optimism spreads. When markets fall, fear spreads. When people around you talk about easy profits, excitement becomes contagious. When they talk about losses, anxiety becomes contagious. Emotional synchronization distorts perception, weakens rational evaluation, and amplifies every signal coming from the crowd. This is why otherwise intelligent individuals make irrational financial decisions when surrounded by excitement or panic. Crowd psychology is especially dangerous in personal finance because financial behavior is cumulative. A single decision made under crowd influence can alter a person's financial trajectory for years. Buying high and selling low compounds losses over time. Following trends instead of developing long-term strategies delays wealth building. Allowing emotional waves to dictate financial choices disrupts consistency, the most important factor in long-term financial security. While the crowd appears powerful in the moment, its influence leaves long-term damage. To understand the mechanics of crowd psychology more deeply, it is necessary to examine the cognitive biases that make individuals vulnerable to group influence. The first is the fear of missing out, a powerful emotional driver that accelerates herd buying. When individuals see others benefiting, they fear being left behind, even if they do not fully understand the opportunity. The second is loss aversion, which amplifies herd selling because losses feel more painful than gains feel rewarding. The third is confirmation bias, which leads individuals to seek information that matches the crowd's behavior and ignore information that contradicts it. When enough people believe an asset will rise forever, confirmation bias filters out warnings and amplifies optimism. Another key bias is the illusion of safety in numbers. In financial decisions, people often feel safe when they behave like the majority. If the majority buys a certain asset, it creates a sense of protection. If everyone is doing it, it must be right. But in financial history, the majority has often been wrong at turning points. The crowd is typically most confident near market peaks and most fearful near market bottoms. Following the majority at these moments ensures poor timing. There is also the status bias, where people assume that financially successful individuals must be correct in their investment choices. This bias magnifies the impact of influencers, celebrities, high-income peers, or public figures who share financial opinions. Even when these individuals lack expertise, their confidence persuades the crowd. Status bias has repeatedly led people to follow advice that aligns with popularity rather than logic. Understanding these biases is essential because crowd psychology does not operate through deliberate persuasion. It operates through instinct, emotion, and unconscious imitation. Individuals often believe they are making rational decisions, even when they are simply echoing the crowd. This self-deception makes crowd influence more powerful than any advertisement, article, or financial presentation. It penetrates decisions without triggering resistance or skepticism. Crowd psychology becomes even more potent when financial information spreads quickly. Modern systems, social media, online communities, viral content, trending topics, accelerate the spread of emotional signals. Positive sentiment amplifies rapidly. Negative sentiment spreads immediately, and the velocity of influence increases. As a result, the crowd becomes larger, faster, more reactive, and more volatile. This environment makes personal finance more psychologically challenging than in any previous era. Another reason crowd psychology is the greatest enemy of personal finance is that it disguises itself as rational behavior. When a large number of people invest in the same asset, it creates the illusion of consensus. Consensus appears to be logic. Consensus appears to be evidence. Consensus appears to be a form of truth. But financial truth is not determined by how many people believe something. It is determined by fundamentals, intrinsic value, long-term patterns, and objective analysis. The crowd does not measure any of these. It measures hope, fear, imitation, and momentum. The most dangerous moment in personal finance occurs when the crowd becomes unanimous. When everyone agrees on the same financial idea, this asset will never fall. This is the safest investment. Everyone is buying this now. That agreement signals extreme risk. In decades of financial history, moments of near unanimous consensus have preceded sharp reversals. But in the moment, consensus feels comforting, not dangerous. This contrast between perception and reality is exactly why crowd influence causes financial harm. Crowd psychology also undermines long-term financial discipline. Even individuals who create strategic plans often abandon them when emotional waves become strong. A well-constructed plan may instruct someone to invest consistently regardless of market conditions, to hold long-term assets through volatility, or to avoid speculative behavior. But when the crowd becomes excited, discipline erodes. When the crowd becomes fearful, discipline collapses. Financial plans fail not because the strategy is flawed but because psychology overrides logic. One of the most subtle and important effects of crowd influence is distorted time perception. Under crowd excitement, individuals believe opportunities are urgent and temporary. Under crowd fear, individuals believe risks are permanent and unavoidable. These shifts in perception distort timing, which is the core of personal financial success. Good timing requires objective evaluation, not emotional urgency. Crowd influence destroys timing by compressing decisions into emotional reactions. To protect personal finance from the dangers of crowd psychology, one must develop awareness, distance, and independent judgment. Awareness means recognizing the signs of herd behavior and identifying the emotional signals that influence decision-making. Distance means resisting the impulse to imitate trends and observing the crowd's behavior from an external perspective. Independent judgment means making decisions based on long-term logic, not short-term emotion. These skills are not natural, they require deliberate practice. Human psychology evolved for social survival, not financial optimization. Therefore, resisting the crowd feels uncomfortable. Acting independently feels risky. Maintaining discipline feels unnatural when others behave differently. Yet these abilities distinguish people who achieve long-term financial stability from those who remain vulnerable to emotional waves. Crowd psychology is powerful because it reflects the basic human desire to belong, to avoid regret, and to seek certainty. But financial success requires a different form of thinking, one that prioritizes rationality over emotional alignment, patience over urgency, and long-term clarity over short-term noise. Understanding the mechanics of crowd influence is the first step toward building such thinking. Crowd psychology is not an external threat, it arises from within. It is not an adversary that can be eliminated, it is a force that must be understood. It does not disappear with knowledge, it becomes manageable through awareness. Once an individual recognizes the influence of the crowd, they gain the ability to make financial decisions grounded in logic rather than emotion. And this is the foundation required to explore the deeper dimensions of financial behavior, how emotions synchronize across groups, how markets reflect collective psychology, and how personal finance becomes more stable when the individual steps outside the emotional wave. Crowd psychology becomes even more influential when financial information expands faster than an individual's ability to process it. Modern environments expose people to a continuous stream of market updates, opinions, predictions, price movements, and emotionally charged commentary. This accelerates uncertainty instead of reducing it. When the mind becomes overloaded with fragmented information, it seeks shortcuts. The simplest shortcut is to adopt the behavior of those who appear confident or numerous. This is how large groups develop synchronized financial behavior even when most individuals lack a full understanding of what they are doing. This synchronization emerges because human reasoning is not purely analytical. It is shaped by perception, emotion, and the context surrounding each decision. In personal finance, people do not simply ask, "Is this a good investment based on fundamentals?" They subconsciously ask, "Is this what others are doing?" Or, "What if I am wrong while everyone else is right?" Or, "Will I regret being the only one who behaves differently?" These unspoken questions reveal the psychological weight of belonging. The fear of social divergence often exceeds the fear of financial loss. Even though people rarely admit it, financial mistakes driven by the crowd feel less painful because they are shared. But independent mistakes feel more isolating, even when they are less costly. This explains why individuals often follow the majority even when the majority is irrational. The financial environment magnifies these effects because markets are inherently uncertain. Uncertainty creates anxiety. Anxiety increases sensitivity to external cues. And external cues often come from the crowd. When people feel unsure about the future of their savings, investments, or income. They look outward instead of inward. They search for patterns in the behavior of others. They watch for signals that confirm their fears or soothe their uncertainty. The crowd provides these signals, but they are emotional rather than logical. This emotional influence becomes a dominant force in decision-making, especially in situations where consequences are invisible, delayed, or unknown. Another dimension of crowd psychology is the amplification of narratives. Narratives are simplified stories that spread easily because they are emotionally resonant. In finance, narratives often reduce complex market dynamics into short, persuasive explanations. These narratives appear as predictions, warnings, success stories, or simplified models of how the market should behave. When enough people believe a narrative, it becomes a self-reinforcing loop. People invest based on it, talk about it, share it, and react to it. The narrative shapes the crowd, and the crowd strengthens the narrative. Eventually, the narrative becomes disconnected from underlying data but continues to influence financial decisions. Narratives gain power because they reduce uncertainty. When individuals encounter an overwhelming amount of conflicting financial information, a simple narrative feels stabilizing. It offers clarity even when inaccurate. It provides direction even when misleading. This is why narratives sustain financial bubbles and deepen financial crashes. When optimism spreads, narratives of infinite growth dominate. When fear spreads, narratives of irreversible decline take over. In both cases, the crowd amplifies the story beyond its factual basis. Crowd psychology also influences risk perception. Humans evaluate risk relative to what others are doing. When many people take a particular risk, it appears safer. When few take it, it appears dangerous. This relative perception is a psychological shortcut that often leads to distorted conclusions. For example, speculative assets appear safe when the crowd is enthusiastic, even if fundamentals are weak. Conversely, high-quality assets appear unsafe when the crowd is fearful, even if fundamentals remain strong. This inversion of risk is the hallmark of crowd-driven decision-making. It reverses the logic that should guide personal finance, buying quality at discounted prices and avoiding overpriced speculative assets. Instead, the crowd buys when prices rise and sells when prices fall, reinforcing volatility. One of the most subtle mechanisms of crowd psychology is the shift in what individuals perceive as normal. Human expectations adjust to the behavior of the majority. When people observe others spending aggressively, borrowing freely, or chasing high-risk opportunities, these behaviors start to feel acceptable. Over time, they may feel necessary. This normalization process changes how people evaluate their own financial choices. Rather than relying on objective criteria like savings rate, debt level, investment horizon, or long-term goals, individuals compare themselves to the crowd. If the crowd's behavior shifts, their sense of what is financially reasonable shifts as well. This destabilizes personal finance because it decouples financial decisions from fundamental principles and attaches them to social trends. The normalization effect also influences lifestyle inflation. When a large group of peers increases their spending, upgrades their possessions, or adopts more expensive habits, individuals feel pressured to match these behaviors, even if they can financially afford these choices. The motivation is not internal but social. This turns personal finance into a competitive arena rather than a disciplined long-term strategy. Over time, the desire to keep pace with the crowd erodes savings, reduces investment capacity, and increases financial fragility. Another consequence of crowd psychology is the erosion of financial patience. Investing, saving, and wealth building require time. They require consistency and delayed gratification. But when the crowd becomes impatient, individuals absorb that impatience. The desire for rapid results becomes contagious. People feel frustrated if their investments do not rise immediately. They feel anxious when others claim quick profits. This impatience leads to frequent switching of strategies, abandoning long-term plans, or chasing short-lived opportunities. The cycle of impatience undermines compounding, which is the most powerful force in personal finance. When financial patience collapses, long-term wealth building collapses with it. Crowd psychology also distorts evaluation of expertise. When a financial idea gains popularity, Individuals often assume it must come from credible sources. But popularity does not equal expertise. Many widely shared financial opinions originate from individuals without formal knowledge, without understanding of risk, and without accountability for the outcomes. Yet, these opinions spread because they align with emotional states already present in the crowd. People tend to believe opinions that match their desires, fears, or hopes. This affects decision-making because the perceived authority of an idea becomes tied to its popularity rather than its accuracy. As more people adopt the idea, its perceived legitimacy grows, accelerating the cycle of influence. A deeper problem emerges when individuals confuse confidence with credibility. Confident voices attract attention. They project certainty in an uncertain environment. But confidence is a performance, not evidence. The crowd often elevates individuals who speak with certainty even when their predictions lack substance. This dynamic leads people to trust persuasive narratives over data-driven analysis. It reinforces emotional decision-making under the illusion of rational judgment. Crowd psychology also affects financial memory. When many people hold the same belief, it becomes difficult to challenge, even if evidence contradicts it. Collective beliefs shape how people interpret information. When the crowd believes the market will continue rising, warnings appear exaggerated. When the crowd believes decline is inevitable, positive signals appear insignificant. This selective interpretation creates collective blind spots that persist until extreme market events force re-evaluation. But by the time the crowd adjusts its beliefs, the financial opportunity associated with the shift has already passed. Financial memory also shortens under crowd influence. People forget past mistakes when enthusiasm is high. They forget past successes when fear dominates. This cyclical amnesia perpetuates repeated financial errors across generations. Market cycles become emotional cycles because people interpret each event as unprecedented, even though similar events have occurred many times before. The crowd forgets during optimism and panics during fear. And individuals who follow the crowd repeat the same mistakes without recognizing the pattern. Crowd influence intensifies when individuals lack personal financial frameworks. Without principles grounded in long-term thinking, people default to the behavior of their environment. They adopt financial habits, investment preferences, spending patterns, and risk attitudes from those around them. This outsourcing of financial judgment increases susceptibility to emotional waves. A strong personal framework acts as a stabilizing force. But most people never develop one. They navigate financial decisions reactively, responding to trends rather than guiding themselves with stable principles. This leaves them exposed to all forms of crowd-driven volatility. The environment in which financial behavior occurs also shapes crowd influence. When people spend time in communities where financial fear dominates, their own financial perspective becomes more cautious. When they spend time in communities focused on speculation, their attitudes become more risk-seeking. Social environments function like emotional amplifiers. They magnify whichever sentiment is dominant. This is why entire groups of people can shift from confidence to fear simultaneously, even when nothing substantial has changed in the underlying financial reality. Crowd psychology also creates the illusion of momentum. When people observe rising prices, increasing demand, or widespread enthusiasm, they interpret these signals as confirmation of opportunity. But market momentum often reflects emotional momentum. Prices rise because people expect them to rise. Demand increases because people fear missing out. The illusion of momentum encourages individuals to join the trend, reinforcing the motion without understanding its underlying cause. When the emotional foundation collapses, the momentum reverses suddenly, leaving the crowd unprepared. Similarly, during market declines, falling prices trigger fear, and fear triggers more selling. This downward feedback loop magnifies volatility and creates financial stress. Individuals who rely on crowd signals during these periods experience high emotional turbulence. Stress becomes the dominant driver of decisions. Under stress, the ability to evaluate information objectively diminishes. This is why crowd-driven financial decisions are often marked by extreme timing errors, buying after prices have risen significantly and selling after prices have already fallen. The most powerful aspect of crowd psychology is its subtlety. Individuals rarely recognize when they are influenced. The influence does not arrive as a command. It arrives as a feeling. It feels like urgency, excitement, reassurance, or fear. Emotions disguise themselves as logic. They present themselves as rational evaluation. But underneath the surface, the emotional state of the crowd dictates the internal narrative. The individual believes they are thinking independently, but their thoughts reflect the surrounding emotional environment. Awareness of crowd psychology begins with recognizing emotional shifts. When an individual senses rising excitement in themselves, they must ask whether this excitement is internal or borrowed from the crowd. When they feel fear, they must ask whether the fear is based on personal assessment or collective anxiety. This examination does not eliminate emotion, but it exposes its origin. Once the origin is visible, emotional influence loses its silent authority. Understanding crowd psychology is not about rejecting the crowd in all circumstances. It is about recognizing when the crowd's behavior contradicts long-term financial logic. Successful financial behavior requires distinguishing between trends driven by fundamentals and waves driven by emotion. This distinction is subtle because fundamentals change slowly while emotions change quickly. The crowd responds to emotion, not fundamentals. Those who understand this difference position themselves above the emotional wave instead of being carried by it. Crowd psychology continues to shape financial outcomes even when individuals believe they are acting rationally. This influence becomes most evident when people attempt to interpret market signals. Markets are not merely collections of prices, they are reflections of collective expectations, fears, beliefs, and emotional responses. Because prices represent aggregated behavior, individuals often mistake crowd-driven movements for objective information. When prices rise, they assume there must be fundamental reasons behind the increase. When prices fall, they assume negative fundamentals must exist. This misinterpretation creates a feedback loop in which emotional behavior is mistaken for genuine market insight, reinforcing the power of the crowd. The separation between fundamental value and perceived value widens significantly under crowd influence. Fundamental value is anchored in long-term economic reality, earnings, productivity, demand, supply, and financial stability. Perceived value, however, is shaped by emotional waves transmitted through the crowd. When emotional momentum rises, perceived value exceeds fundamentals. When emotional momentum collapses, perceived value falls below fundamentals. Individuals who lack the ability to distinguish between the two become vulnerable to the crowd's oscillations. Their decisions follow short-term sentiment rather than long-term logic, resulting in misaligned timing, excessive risk-taking, and vulnerability to volatility. Another factor that strengthens crowd psychology is the limited visibility of long-term consequences. Human cognition is more sensitive to immediate emotional signals than delayed outcomes. The crowd provides immediate emotional signals, excitement, fear, urgency, whereas long-term financial results unfold slowly and quietly. People often respond more strongly to the emotional atmosphere around them than to the eventual outcomes of their decisions. This imbalance between emotional immediacy and delayed consequences leads individuals to align with the crowd even when they know, at a rational level, that long-term discipline is more beneficial. The emotional atmosphere of the crowd can override personal principles. Even among those who believe they are disciplined, individuals may construct careful financial plans, set long-term goals, and commit to consistent strategies. But these commitments exist at the cognitive level. Emotional influence operates at a deeper level, below conscious awareness, and can undermine these commitments without individuals recognizing the shift. A rising market can create a sense of urgency that pushes individuals to increase risk exposure. A falling market can trigger anxiety that makes them abandon long-term positions. These decisions feel justified in the moment because emotional reasoning disguises itself as strategic thinking. Crowd psychology also affects the information people choose to consume. Information that aligns with the crowd's emotional state becomes more prominent, while information that contradicts the prevailing sentiment becomes less visible. This filtering mechanism is not deliberate, it is an unconscious process driven by emotional resonance. When optimism dominates, positive information seems more credible, more meaningful, and more compelling. Negative information appears overly cautious or irrelevant. When pessimism dominates, negative information becomes magnified, and positive information appears unrealistic. This selective attention reinforces the emotional state of the crowd, making it more powerful and harder to resist. Another mechanism through which crowd psychology influences personal finance is through comparison. Human beings constantly compare their progress, choices, and outcomes with those of others. In finance, these comparisons often distort perception. When individuals see others achieving faster or larger gains, they feel inadequate. When they see others avoiding losses, they feel insecure. These emotional reactions drive behavior that mimics the crowd rather than reflects thoughtful decision-making. Comparisons magnify emotional fluctuations and destabilize long-term plans. Even more powerful is the emotional normalization of extreme market conditions. During periods of financial mania, dramatic price increases become normalized. Individuals who would ordinarily view such increases with skepticism begin to see them as reasonable. During financial downturns, severe declines become normalized, and individuals adopt extreme caution even when opportunities exist. This normalization process leads people to absorb and internalize the emotional tone of the crowd, reshaping their sense of what is financially plausible, acceptable, or logical. The influence of crowd psychology is amplified by the structure of modern communication. Digital platforms compress time, reduce the cost of sharing information, and magnify the visibility of emotional content. Emotional signals spread faster than analytical ones. Short-form content that triggers excitement or fear spreads more rapidly than long-form content that explains fundamentals. This structural imbalance accelerates emotional contagion. When individuals consume emotionally charged content repeatedly, their internal emotional state gradually aligns with the dominant sentiment of the crowd. This alignment shapes decisions before rational evaluation occurs. Another core issue is the way crowd psychology influences the perception of opportunity. Opportunities in finance are rarely obvious. They require calm analysis during moments of uncertainty. But the crowd typically perceives opportunity only when emotional excitement is high. By that point, prices often reflect excessive optimism. Conversely, the crowd sees danger when emotional fear peaks, when prices have already declined significantly and potential opportunities emerge. Individuals who rely on crowd signals thus invert the logic of successful financial behavior. They identify opportunities only when opportunities have diminished, and they avoid opportunities when they are more favorable. This inversion is reinforced by emotional memory. People remember emotional intensity, not factual accuracy. If a financial event triggered strong excitement or fear in the past, individuals attach emotional weight to similar events in the future. This emotional memory shapes expectations in subtle ways. When individuals recall the excitement of past gains, they become more susceptible to speculative behavior during future periods of optimism. When they recall the pain of past losses, they become more susceptible to panic during future declines. Emotional memory becomes a guide for behavior, even though it is an unreliable predictor of financial reality. Crowd psychology also affects how individuals interpret randomness. Financial markets contain significant randomness, but the crowd tends to impose narratives on random events. A short-term rise is interpreted as evidence of strength. A short-term decline is interpreted as evidence of weakness. These interpretations are not grounded in fundamentals. They reflect the emotional environment at the time. Individuals influenced by the crowd tend to attribute meaning where none exists, reinforcing emotional reactions and obscuring objective analysis. One of the most powerful and overlooked effects of crowd psychology is its impact on self-assessment. Individuals rarely view their financial decisions as emotionally driven. They believe they are making rational choices. But emotional influence operates below conscious awareness. When individuals adopt the crowd's emotional state, they reinterpret their own motivations. They create explanations that justify their actions, even when those actions were driven by unconscious emotional imitation. This self-justification prevents them from recognizing patterns in their own behavior, making them vulnerable to repeating the same mistakes. Crowd psychology gains additional power because it operates collectively. Individuals do not experience their emotions in isolation. They see others expressing similar emotions, interpreting similar signals, and reacting similarly. This creates a reinforcing loop that stabilizes emotional states. When multiple people express confidence, their confidence strengthens. When multiple people express fear, their fear deepens. The crowd becomes an amplifier of emotional signals, making deviations from the prevailing sentiment feel unnatural and risky. This collective reinforcement affects even those who consciously reject crowd behavior. Awareness alone does not provide immunity. Emotional signals still penetrate decision-making through subtle channels. Even when individuals consciously oppose the crowd's actions, they feel the emotional pressure of being different. This pressure can manifest as doubt, hesitation, or second-guessing. Without strong internal frameworks, the emotional influence of the crowd eventually prevails. Crowd psychology also shapes the way individuals experience financial uncertainty. Uncertainty is inherently uncomfortable. The crowd provides a temporary sense of direction, even when that direction lacks logic. During uncertain periods, individuals gravitate toward the crowd because it offers an illusion of clarity. This illusion reduces discomfort but increases financial vulnerability. The crowd's direction may feel safe, but its emotional foundation makes it unstable. When the emotional tone shifts, the crowd changes direction abruptly, leaving individuals who followed it unprepared. The crowd's emotional instability creates cycles of overreaction. When the crowd becomes optimistic, it overestimates potential gains. When it becomes fearful, it overestimates potential risks. These exaggerated perceptions shape financial decisions and distort market signals. Individuals who rely on these exaggerated signals make decisions that reinforce volatility. They buy into optimism and sell into fear, amplifying the cycle. A critical aspect of crowd psychology is its tendency to minimize nuance. Nuance requires time, effort, and analytical capacity. The crowd simplifies complex issues into binary conclusions: good or bad, safe or dangerous, buy or sell. This simplification is emotionally appealing but intellectually shallow. It encourages impulsive decisions rather than thoughtful assessment. Over time, the reduction of nuance leads to fragile financial behavior that cannot withstand volatility. Crowd psychology also erodes autonomy. When individuals internalize the crowd's beliefs, they lose connection to their own financial principles. They defer judgment to external signals rather than developing independent perspectives. This erosion of autonomy creates a dependency on emotional cues. Without autonomy, individuals cannot maintain consistent strategies. Their financial behavior becomes reactive rather than intentional. To understand the full impact of crowd psychology, one must examine how it interacts with financial environments where outcomes are often delayed. The delay between actions and results creates space for emotional influence. When results are not immediate, individuals rely on the crowd's emotional reactions as a guide. This reliance becomes stronger when the environment is noisy and unpredictable. In such environments, emotional guidance feels more accessible than analytical evaluation. This shift from analysis to emotional reaction gradually replaces long-term planning with short-term adaptation. Crowd psychology also alters the way individuals evaluate success. Instead of measuring success based on progress toward long-term goals, individuals begin measuring success relative to the crowd's emotional state. When the crowd is optimistic, they feel they are falling behind. When the crowd is pessimistic, they feel temporarily protected. This relative evaluation disconnects financial behavior from objective markers of progress and ties it to emotional fluctuations that have no relationship to long-term outcomes. The strongest demonstration of crowd psychology's influence is its ability to create collective illusions. Collectively, the crowd can believe that risk has disappeared during periods of optimism or that recovery is impossible during periods of fear. These collective illusions shape investment behavior, policy responses, and financial planning. Individuals who internalize these illusions become detached from realistic assessments. The illusions persist until a significant market event forces a correction. But by the time the correction occurs, the crowd has already influenced a large portion of financial behavior. Recognizing these illusions requires distance from the emotional tone of the crowd. Distance allows individuals to observe crowd behavior without absorbing its emotional content. This observational stance creates room for independent reasoning. It does not eliminate uncertainty, but it reduces the risk of emotional contagion. Maintaining this distance is difficult but essential for long-term financial stability. The final dimension of crowd psychology in personal finance is its relationship to identity. Financial choices become intertwined with social identity when individuals align their beliefs with the crowd. The crowd's emotions become part of how individuals perceive themselves. This connection intensifies emotional responses and increases resistance to counter evidence. When financial beliefs become part of personal identity, changing those beliefs feels like a threat. This resistance anchors individuals to crowd-driven behavior even when it contradicts logic. Understanding how crowd psychology shapes financial identity is critical. Once financial decisions are tied to identity, individuals become less flexible. They defend emotionally driven positions, rationalize mistakes, and resist correction. This rigidity prevents adaptation and increases vulnerability to market shifts. The influence of crowd psychology in personal finance is pervasive, subtle, and powerful. It shapes decisions, expectations, perceptions, and emotions. It guides behavior through unconscious channels. It mimics logic while undermining it. It replaces long-term thinking with emotional alignment. And because it operates through instinct rather than intention, individuals rarely recognize its presence. Crowd psychology shapes financial decisions not only through emotion but also through structural patterns that repeat across generations. These patterns emerge because human behavior changes slowly while information environments evolve rapidly. As long as people experience uncertainty, seek belonging, and interpret signals socially, the crowd will remain a dominant force. Understanding these patterns requires examining the deeper mechanisms that govern how group beliefs form, amplify, and stabilize before eventually collapsing. These mechanisms influence personal finance subtly yet consistently, pushing individuals toward decisions that feel rational in the moment but contradict long-term financial logic. One of the most influential mechanisms is collective reinforcement. When many individuals share similar beliefs or emotional reactions, they reinforce each other's perceptions. This reinforcement does not require explicit communication, it occurs through observation, tone, and the ambient emotional environment. When people witness others speaking confidently about a financial trend, confidence spreads. When they observe doubt or anxiety, these emotions also spread. Over time, collective reinforcement creates an emotional consensus that feels objective even though it emerges from shared emotion, not shared reasoning. Because humans evolved as social animals, they are highly sensitive to group signals. The brain interprets group consensus as a protective indicator. This instinct was useful in early survival contexts but misfires in financial environments. In personal finance, group consensus often forms around emotional narratives rather than analytical truths. The crowd may collectively believe that a market trend is safe, inevitable, or permanent, even when evidence is weak. These beliefs persist because each individual sees them reflected in others, making the collective illusion stronger than any individual's private doubt. Another mechanism that strengthens crowd psychology is the role of salience. People assign importance to information that is more visible, repeated, or emotionally striking. Crowd-driven narratives gain salience because they are shared frequently. Each repetition increases their psychological weight. When individuals hear the same message from multiple sources, they assume it carries truth. This assumption is not grounded in analysis but in cognitive shortcuts that equate repetition with validity. As a result, financial ideas that spread widely, regardless of accuracy, become influential simply because they are present in the collective conversation. Salience also shapes emotional intensity. Information that evokes strong emotions spreads more quickly and receives more attention. The crowd actively amplifies emotionally charged content, accelerating the spread of excitement or fear. This creates a distortion in the information environment. Emotionally neutral but accurate information becomes less visible, while emotionally charged but misleading information becomes dominant. Individuals navigating this environment absorb the strongest emotional signals and mistake them for the most important signals. Another factor is shared vulnerability. Individuals facing uncertainty often look for reassurance. When they see the crowd moving in a particular direction, they feel protected from the risk of acting alone. This perceived safety is deceptive. When many people make the same mistake simultaneously, the collective nature of the error magnifies the impact. But before the consequences appear, group participation creates the illusion that the decision is safe. This illusion persists until market conditions expose its flaws. By the time the consequences become visible, the crowd has already encouraged widespread participation, making the correction more painful. Crowd psychology also interacts with cognitive laziness, the natural human tendency to conserve mental effort. Analytical evaluation is difficult, slow, and uncomfortable. Emotional imitation is fast and effortless. When individuals see the crowd respond with enthusiasm or fear, it becomes easier to mimic the emotional response than to engage in slow, deliberate thought. Over time, this pattern reinforces itself. Individuals become more accustomed to outsourcing judgment to social signals. Their internal decision-making systems weaken. Financial behavior becomes reactive rather than intentional. Another mechanism is the contagion of urgency. The crowd often communicates emotional urgency even when no real deadline exists. When people observe others rushing to buy or sell, the speed of their actions creates psychological pressure. Individuals fear being left behind or suffering losses if they hesitate. This perceived urgency distorts time perception. Short-term emotional pressure overshadows long-term strategy. Decisions become compressed, driven by the speed of the crowd rather than the logic of the situation. Financial markets amplify this urgency because price movements occur continuously. Rising prices create urgency to buy. Falling prices create urgency to sell. The rapidity of these movements reinforces crowd-driven decisions. When individuals see prices move quickly, they interpret momentum as validation. But momentum is often the product of crowd behavior itself, not underlying fundamentals. This creates a circular process. Emotional behavior drives price movement, and price movement drives emotional behavior. Crowd psychology also alters the perception of responsibility. When individuals follow the crowd, they feel less accountable for the outcomes. Responsibility becomes diluted across the group. This dilution reduces the psychological pain associated with potential losses. If everyone experiences the same negative consequences, individuals feel less personal blame. This reduced sense of responsibility encourages risk-taking because it minimizes the emotional cost of failure. Conversely, independent decisions carry the full weight of responsibility. The fear of being wrong in isolation makes independent thinking psychologically expensive, pushing individuals back toward the safety of group conformity. Another powerful factor is the illusion of expertise within the crowd. As narratives spread, certain voices gain prominence. These voices often speak with confidence and conviction, giving the impression of knowledge. But confidence is not expertise, and conviction does not guarantee accuracy. Crowd psychology elevates these voices because they fit the emotional needs of the group. When individuals feel uncertain, they gravitate toward authoritative-sounding opinions. The more individuals follow these voices, the more legitimate they appear. This legitimacy becomes self-reinforcing, even when the core insights are weak or incorrect. The illusion of expertise is dangerous because it encourages reliance on opinions rather than analysis. Once individuals internalize these opinions, they become less receptive to contradictory evidence. The emotional appeal of the narrative overshadows the logical inconsistencies. This resistance to disconfirming information exacerbates financial vulnerability. Crowd psychology also erodes risk awareness. The crowd tends to focus on short-term emotional outcomes rather than long-term consequences. When optimism dominates, individuals underestimate risk, believing the crowd's enthusiasm indicates safety. When fear dominates, individuals overestimate risk, believing the crowd's anxiety signals danger. This emotional imbalance leads to miscalibrated risk perception. People take excessive risks during euphoric periods and avoid reasonable risks during pessimistic periods. Both extremes damage long-term financial performance. Another factor influencing risk perception is the crowd's tendency to generalize from limited experiences. During a rising market, individuals generalize recent gains as indicators of future performance. During a downturn, they generalize recent losses. These generalizations are not based on probabilities or historical data. They are emotional interpretations of recent events amplified by the crowd's emotional tone. This distorts decision-making and reinforces the dominant sentiment of the crowd. Crowd psychology also undermines diversification. When the crowd becomes focused on a specific asset class, individuals tend to over-concentrate their investments. They may allocate disproportionate amounts to a single category because it appears popular or successful. This behavior increases vulnerability because lack of diversification magnifies the impact of volatility. Diversification requires resisting the emotional pull of trending assets, which becomes difficult when surrounded by widespread enthusiasm. The crowd's uniform focus makes alternative choices feel unnecessary or even misguided. The crowd also influences how individuals define financial success. Success becomes measured relative to the crowd rather than relative to personal goals. If others achieve rapid gains, individuals feel unsuccessful even when they are making steady progress. If the crowd suffers losses, individuals may feel temporarily safe despite lacking a solid financial foundation. This relative evaluation detaches financial behavior from intrinsic goals and attaches it to shifting external benchmarks. Over time, this undermines financial stability because individuals chase external validation rather than long-term outcomes. Another mechanism is the internalization of collective assumptions. These assumptions often go unchallenged because they are widely believed. When enough people assume that a particular trend will continue indefinitely, it starts to shape planning, spending, and investment decisions. Individuals build expectations around these assumptions, even if they are unsupported by evidence. Eventually, when market conditions change, these assumptions collapse, exposing the fragility of crowd-driven planning. Crowd psychology also creates a false sense of inevitability. When trends persist for a long period, individuals begin to believe they are permanent. Rising markets feel invincible. Declining markets feel unavoidable. These feelings are emotional interpretations, not logical assessments, but because they are shared by the crowd, they feel collective and therefore credible. This credibility shapes decisions and reinforces the momentum of financial cycles. Another factor is the way crowd psychology reshapes risk-taking thresholds. During euphoric periods, individuals raise their risk tolerance because the crowd signals that higher risk is acceptable. During fearful periods, individuals lower their risk tolerance excessively, avoiding even reasonable opportunities. These fluctuating thresholds undermine consistency. Long-term financial performance requires stable risk preferences grounded in objective principles. But the crowd's emotional shifts destabilize these preferences, making individuals more vulnerable to timing errors. Crowd psychology also distorts aspirations. When individuals see others pursuing financial goals that appear attractive, they may adopt those goals without assessing their personal relevance. This misalignment between personal values and crowd-driven aspirations creates dissatisfaction and confusion. Financial goals should reflect individual needs, but crowd influence replaces those needs with external expectations. This substitution reduces long-term satisfaction and financial coherence. The emotional tone of the crowd also affects individuals' perception of their own competence. During optimistic periods, people feel more capable than they actually are. They interpret successful outcomes as evidence of skill rather than luck. During pessimistic periods, people feel less capable. They interpret negative outcomes as personal failures rather than market fluctuations. These swings in perceived competence distort decision-making. Overconfidence leads to excessive risk-taking. Underconfidence leads to missed opportunities. Both extremes weaken long-term financial stability. Another subtle effect of crowd psychology is the erosion of personal criteria. When individuals rely heavily on the crowd, they lose sight of the criteria that matter most in personal finance: time horizon, liquidity needs, risk tolerance, savings capacity, and long-term goals. Instead, decisions become anchored to external signals. This displacement of internal criteria creates fragility. Individuals can only navigate financial uncertainty effectively when their decisions are grounded in stable internal principles. Crowd influence also alters emotional baselines. During prolonged optimism, Elevated emotional states feel normal. During prolonged pessimism, depressed emotional states feel normal. These emotional baselines shape expectations. When optimism feels normal, individuals underestimate risk. When pessimism feels normal, they underestimate opportunity. These distorted baselines make it difficult to return to balanced reasoning. In environments where the crowd's emotional state shifts rapidly, individuals experience emotional whiplash. This rapid oscillation destabilizes judgment. People become reactive, constantly adjusting to emotional cues rather than evaluating long-term trends. The instability creates exhaustion, which further reduces analytical capacity. Over time, individuals may disengage from thoughtful decision-making altogether, relying exclusively on crowd signals. This reliance turns personal finance into an emotional echo of the crowd's fluctuations. Crowd psychology influences every layer of financial decision-making: perception, interpretation, reaction, and expectation. Its effects compound over time, shaping patterns of behavior that appear rational but are deeply rooted in collective emotional dynamics. The challenge for individuals is not simply avoiding the crowd but developing the clarity to recognize when the crowd's influence contradicts long-term logic. This clarity emerges from awareness, distance, and internal stability. Without these elements, individuals remain tethered to the crowd's emotional currents, vulnerable to the same cycles of excitement and fear that have repeated for centuries. Crowd psychology continues to shape financial outcomes through mechanisms that operate beneath conscious awareness, influencing how individuals evaluate information, anticipate trends, and respond to uncertainty. These underlying forces are most visible when examining how people form expectations about the future. Expectations in personal finance rarely emerge from isolated reasoning. Instead, they are shaped by collective emotional patterns that propagate through social networks, media systems, and behavioral feedback loops. Understanding how expectations form and spread is essential for recognizing how deeply crowd psychology penetrates financial judgment. Expectations are often treated as rational predictions based on data, but in reality, they frequently reflect the emotional climate of the crowd. When the crowd is optimistic, expectations shift upward. When the crowd is fearful, expectations shift downward. These shifts occur even when underlying fundamentals remain unchanged. The emotional tone sets the interpretive frame through which individuals view data. This framing effect alters the significance they assign to various indicators. During optimism, positive signs appear more meaningful. During fear, negative signs dominate attention. This distortion of significance causes expectations to swing between extremes, weakening long-term financial planning. Another dimension of expectation formation is the reliance on extrapolation. Individuals tend to project recent trends into the future, especially when those trends align with the crowd's emotional state. If the crowd is optimistic, recent positive outcomes are extrapolated indefinitely. If the crowd is pessimistic, recent negative outcomes are assumed to continue. Extrapolation feels logical because it simplifies an uncertain future into a linear extension of the present. But financial systems rarely move linearly. They move in cycles influenced by structural forces, not by emotional continuity. Extrapolation rooted in emotion rather than analysis reinforces crowd-driven patterns and increases vulnerability to reversals. Crowd psychology also affects how individuals interpret ambiguity. Ambiguity is inherent in financial decisions. Most financial information is probabilistic, not deterministic, but ambiguity triggers emotional discomfort. To ease this discomfort, individuals look for cues that reduce perceived uncertainty. The crowd provides these cues, but they are emotional signals disguised as clarity. When individuals adopt the crowd's interpretation of ambiguous information, they experience a sense of resolution that feels rational even when it is grounded in emotion. This borrowed clarity reduces anxiety but increases susceptibility to collective errors. The process of emotional alignment with the crowd further complicates individual judgment. When individuals align emotionally with the crowd, they begin to interpret new information through the lens of the crowd's dominant mood. If the crowd is excited, individuals interpret ambiguous signals as positive. If the crowd is fearful, Ambiguous signals become negative. This interpretive filter reinforces the crowd's emotional trajectory, creating momentum that amplifies collective sentiment. Over time, the emotional interpretation becomes so ingrained that individuals forget to question the underlying assumptions. Crowd psychology also shapes the way individuals view financial cycles. Cycles are fundamental to economic and market behavior. They reflect structural forces such as capital flows, interest rate regimes, technological change, and demographic patterns. However, the crowd tends to interpret cycles emotionally rather than analytically. During expansion phases, the crowd believes the expansion will last indefinitely. During contraction phases, the crowd believes recovery is impossible. These emotional interpretations distort the perception of where the cycle actually stands. Individuals who rely on crowd sentiment to interpret cycles make decisions that exaggerate the highs and deepen the lows. One of the most insidious effects of crowd psychology is the erosion of internal reference points. Internal reference points include personal risk tolerance, long-term financial objectives, savings discipline, and investment time horizon. When individuals absorb the emotional tone of the crowd, these reference points shift unconsciously. For example, risk tolerance increases during euphoric periods and decreases during fearful periods, even though an individual's actual capacity for risk has not changed. This shift undermines consistency, which is essential for long-term financial success. Without stable internal reference points, individuals become reactive, adjusting their strategies in response to emotional pressure rather than rational evaluation. Another important factor is the role of emotional contagion in decision timing. Timing is one of the most misunderstood and misapplied concepts in personal finance. Good timing is not about predicting the future precisely. It is about aligning decisions with long-term logic rather than short-term emotion. But emotional contagion distorts timing by creating pressure to act at the same moments as the crowd. When the crowd buys, the pressure to buy increases. When the crowd sells, the pressure to sell escalates. This synchronization leads to systematically poor timing, buying at inflated prices and selling at depressed prices. The repeated pattern contributes to long-term financial underperformance. Crowd psychology also influences the way individuals evaluate regret. Regret is a powerful emotion that shapes decision-making. People fear financial regret more intensely when acting independently than when acting with the crowd. If an individual makes an independent decision that leads to loss, the regret feels personal and acute. If they follow the crowd and experience loss, the regret is diffused across the group. This asymmetry creates a bias toward conformity. People prefer shared regret to solitary regret, even though solitary decisions may be more rational. This preference for shared regret reinforces crowd-driven behavior and reduces the likelihood that individuals will break away from the dominant emotional pattern. Another mechanism influenced by crowd psychology is the valuation of opportunity cost. Opportunity cost is a foundational concept in personal finance, but emotional states distort how individuals perceive it. During optimistic periods, individuals overestimate the opportunity cost of not participating in popular trends. They fear missing potential gains. During pessimistic periods, individuals overestimate the opportunity cost of taking reasonable risks. They fear experiencing additional losses. These distorted perceptions of opportunity cost push individuals toward decisions that align with crowd sentiment even when those decisions contradict long-term financial logic. Crowd psychology also affects the development of financial habits. Habits form through repetition, reward, and emotional reinforcement. When the crowd reinforces certain financial behaviors, saving, spending, or investing, individuals internalize these behaviors more easily. But when crowd sentiment shifts, habit reinforcement often collapses. For example, during periods of optimism, saving may feel unnecessary, weakening savings discipline. During periods of fear, investing may feel dangerous, reducing investment consistency. These fluctuations hinder the formation of stable habits, making financial progress uneven and fragile. Another subtle effect is the way crowd psychology shapes mental accounting. Mental accounting refers to the way individuals categorize and value their money based on psychological factors rather than objective criteria. The crowd influences mental accounting by altering the emotional significance of different financial categories. For example, during market expansions, individuals may treat speculative gains as disposable, bonus money, leading to increased risk-taking. During contractions, they may treat modest losses as catastrophic, leading to excessive caution. These emotional categorizations distort rational decision-making and create inconsistencies in financial behavior. Crowd psychology also interferes with an individual's ability to evaluate long-term trade-offs. Long-term financial decisions often require discomfort in the present, saving rather than spending, investing rather than consuming, remaining patient during volatility. But when the crowd prioritizes short-term emotional comfort, individuals absorb this preference. They prioritize present emotional alignment over future financial benefit. This shift undermines compounding, delays progress, and weakens resilience. The crowd's focus on short-term emotion becomes a barrier to long-term strategy. Another significant dimension of crowd psychology is the distortion of perceived probabilities. When individuals observe the crowd reacting strongly to a specific risk or opportunity, they overestimate its probability. Emotional intensity acts as a substitute for statistical evaluation. If the crowd fears a recession, individuals assume its likelihood is high. If the crowd expects rapid gains, individuals assume these gains are probable. This emotional substitution for probabilistic reasoning leads to decisions that are misaligned with actual risk distributions. Over time, repeated misjudgments of probability accumulate into larger financial errors. Crowd psychology also influences how individuals respond to shocks. Financial shocks, such as sudden market drops, geopolitical events, or economic disruptions, create uncertainty. The crowd often reacts emotionally, making exaggerated interpretations. Individuals who absorb these exaggerated reactions respond impulsively. Instead of evaluating the long-term impact of the shock, they react to the emotional intensity of the crowd's response. This leads to premature decisions that undermine long-term plans. The tendency to treat crowd emotion as a proxy for actual risk magnifies the impact of shocks on personal finance. Another mechanism is the internalization of collective stories of success and failure. The crowd often highlights extreme outcomes, stories of rapid wealth accumulation or sudden financial collapse. These stories trigger emotional responses that shape expectations. Individuals may pursue strategies based on rare success stories, ignoring the low probability of achieving similar results. Alternatively, they may avoid reasonable risks because of vivid stories of loss. Both reactions are shaped by the emotional resonance of crowd-driven anecdotes rather than by data or probability. Crowd psychology also affects self-regulation. Self-regulation involves controlling impulses, delaying gratification, and maintaining consistency. Emotional intensity weakens self-regulation. When individuals encounter strong emotional signals from the crowd, those signals compete with internal discipline. During periods of optimism, the impulse to chase gains overrides restraint. During periods of fear, the impulse to escape losses overrides patience. Emotional waves disrupt the stability required for disciplined financial behavior. Another issue is the erosion of financial boundaries. Individuals establish boundaries to protect their financial health, limits on spending, risk exposure, debt, and consumption. Crowd influence weakens these boundaries by normalizing behaviors that exceed them. If the crowd engages in excessive spending, individuals feel justified in doing the same. If the crowd takes on high-risk investments, individuals loosen their boundaries without recognizing the shift. This erosion increases vulnerability and reduces long-term control. Crowd psychology also influences perceptions of fairness. When individuals observe others achieving financial gains easily, they perceive the system as unfair if they are not experiencing the same. This perception triggers emotional responses that affect behavior. Some individuals take excessive risks in an attempt to catch up. Others disengage from financial planning due to frustration. Both reactions undermine long-term stability because they are rooted in emotional comparisons rather than strategic thinking. Another mechanism is the way crowd psychology interacts with technological amplification. Digital platforms reward emotional content, making emotionally charged financial information more visible. Individuals exposed to this content internalize emotional patterns more rapidly. The constant visibility of the crowd's reactions accelerates emotional contagion. This technological amplification increases the frequency and intensity of emotional cycles, making it even harder for individuals to maintain independent thinking. Crowd psychology also shapes how individuals evaluate their identity as financial actors. People often interpret their financial outcomes as reflections of their competence or worth. When they absorb the crowd's emotional tone, they reinterpret their identity accordingly. During optimistic periods, they feel more capable and confident. During fearful periods, they feel less capable. This fluctuation affects decision-making because identity shapes expectations, behavior, and resilience. A fragile financial identity leads to inconsistent decisions. The cumulative impact of crowd psychology creates a distorted internal environment. This environment is characterized by fluctuating emotions, shifting expectations, weakened boundaries, inconsistent habits, and reactive decision-making. Financial decisions made within this environment lack stability. The individual becomes a reflection of the crowd rather than a steward of their own long-term strategy. Without recognizing this dynamic, individuals remain trapped in an emotional cycle that repeats across financial generations. Crowd psychology influences personal finance most profoundly when individuals attempt to make long-term decisions in environments dominated by short-term emotional fluctuations. These fluctuations create a continuous tension between what feels immediately necessary and what is strategically beneficial. The crowd amplifies the immediacy of emotional reactions, making short-term impulses feel urgent and long-term intentions feel abstract. This tension weakens the foundation required for stable financial behavior and contributes to recurring patterns of reactive decision-making that persist across generations. A central factor in this dynamic is the misalignment between emotional cycles and financial cycles. Emotional cycles move quickly, accelerating within days or even hours as collective moods shift. Financial cycles move slowly, shaped by fundamental forces that unfold over years. When individuals use emotional signals from the crowd to guide decisions, they mistakenly apply short-term emotions to long-term environments. This mismatch leads to repeated errors. Individuals become aggressive at the top of cycles when enthusiasm is high and defensive at the bottom when fear is widespread. Because the emotional cycle moves ahead of the financial cycle, individuals who follow the crowd consistently react too late. Another mechanism that deepens crowd influence is the conflation of volatility with danger. Volatility is a natural characteristic of financial markets. It reflects both uncertainty and opportunity. But the crowd interprets volatility emotionally. When volatility rises, the crowd views it as a threat. When volatility falls, the crowd interprets it as safety. This emotional misinterpretation shapes decisions in counterproductive ways. Individuals reduce exposure when volatility increases. Even if fundamentals remain sound, they increase exposure when volatility decreases, even if valuations are stretched. Over time, this pattern undermines long-term outcomes by encouraging pro-cyclical behavior that aligns with emotional comfort rather than financial logic. Crowd psychology also affects how individuals interpret the concept of resilience. Resilience in personal finance requires the ability to continue making rational decisions despite emotional discomfort. It requires the willingness to stay invested during downturns, maintain savings discipline during periods of rising consumption, and prioritize long-term goals over short-term trends. But the crowd elevates the importance of emotional relief over long-term resilience. Individuals influenced by the crowd seek immediate emotional resolution, exiting investments during fear, accelerating spending during optimism, or abandoning strategies that require patience. This preference for emotional relief weakens resilience and leads to instability during market stress. Another significant issue is that crowd psychology compresses time horizons. Personal finance requires multi-year decision-making frameworks, but the emotional tone of the crowd makes long horizons feel irrelevant. Individuals begin evaluating decisions based on days or weeks rather than decades. This compression leads to strategies that change frequently, preventing compounding from taking hold. Compounding requires consistency. Crowd-driven behavior disrupts consistency by introducing emotional variability into what should be stable. Long-term decisions. Crowd psychology also creates distortions in the perception of liquidity. Liquidity refers to the ability to access cash when needed. Emotional environments influence how individuals evaluate their liquidity needs. During optimistic periods, individuals underestimate the need for liquidity because the crowd signals safety. They may take on excessive commitments or reduce emergency reserves. During fearful periods, individuals overestimate the need for liquidity because the crowd signals danger. They may liquidate long-term investments prematurely or avoid reasonable opportunities. These distortions undermine financial planning by misaligning liquidity with actual needs. Another mechanism that intensifies crowd influence is the shared belief that collective action reduces individual responsibility. When many people make the same financial decision, individuals feel shielded from personal accountability. This reduces the psychological barrier to taking risks that would otherwise feel unacceptable. The crowd distributes responsibility so broadly that individuals feel protected from the consequences of decisions that stem from collective emotion rather than rational judgment. But this diffusion of responsibility weakens learning. Individuals rarely reflect deeply on decisions made in the context of crowd movements. Without reflection, lessons are not internalized, and mistakes repeat. Crowd psychology also intersects with the human tendency to seek coherence. People prefer narratives that make sense of complex realities. The crowd provides these narratives, but they are constructed to match emotional states, not factual accuracy. During periods of optimism, narratives focus on growth, innovation, and opportunity. During periods of pessimism, narratives focus on risk, instability, and decline. These narratives help individuals feel aligned with the crowd, but they distort the reality that financial environments are rarely as extreme as the crowd believes. The desire for narrative coherence leads individuals to internalize simplified explanations that exaggerate both positive and negative conditions. Another dimension is the way crowd psychology influences the perception of randomness. Humans prefer order and predictability, but financial systems contain significant randomness. The crowd imposes emotional interpretations on random events. A market rise is interpreted as confirmation of optimism. A decline is interpreted as confirmation of fear. These interpretations reinforce emotional narratives rather than acknowledging randomness. The failure to recognize randomness leads individuals to form expectations based on emotional interpretations rather than probability. The internal emotional environment shaped by the crowd also influences self-regulation. Financial self-regulation depends on impulse control, consistency, and the ability to maintain discipline under stress. Crowd-driven emotional waves weaken impulse control by activating strong emotional states. When individuals encounter emotionally charged information repeatedly, their internal emotional equilibrium becomes less stable. They become more reactive, more sensitive to emotional cues, and less capable of deliberate thought. Over time, this reduces the capacity for self-regulation, making individuals more vulnerable to emotional decision-making. Crowd psychology also reshapes what individuals view as reasonable. In personal finance, reasonableness should be defined by objective principles, risk tolerance, time horizon, savings rate, asset allocation, and long-term goals. But the crowd defines reasonableness socially. If the crowd is optimistic, aggressive strategies appear reasonable. If the crowd is fearful, conservative strategies appear reasonable. These shifting definitions distort decision-making because they replace internal financial logic with external emotional consensus. Another factor is the psychological cost of resisting the crowd. Resisting the crowd requires internal stability. It requires the willingness to accept emotional discomfort, tolerate uncertainty, and trust long-term reasoning over short-term emotion. These psychological costs discourage individuals from acting independently, even when they know the crowd is acting irrationally. The emotional burden of holding an unpopular position can feel overwhelming. This burden reinforces conformity, making deviations from crowd sentiment rare. Crowd psychology also affects how individuals experience progress. Financial progress often occurs gradually and quietly, but emotional progress is more immediate and noticeable. When the crowd is optimistic, Individuals feel as if they are progressing even if their financial fundamentals have not improved. When the crowd is pessimistic, individuals feel stagnant even when they are making disciplined decisions. This emotional distortion undermines motivation. People abandon solid strategies because they do not feel progress, despite actually making meaningful long-term improvements. Another subtle influence is the internalization of collective fear thresholds. The crowd responds intensely to specific triggers, market declines, geopolitical events, inflation concerns, or sudden volatility. These triggers activate collective fear responses that individuals internalize. Once internalized, these thresholds shape future decisions. Individuals begin reacting to similar triggers even when the underlying conditions differ. This internalized fear pattern creates recurring cycles of overreaction that misalign decisions with long-term strategy. Crowd psychology also shapes how individuals handle uncertainty within financial systems that lack clear outcomes. When individuals cannot determine the correct decision decisively, they rely more heavily on crowd signals. This reliance is strengthened by the emotional comfort provided by group alignment. The crowd's emotional state fills the void left by the lack of clarity, creating a false sense of direction. This borrowed sense of direction reduces discomfort but increases vulnerability because it is rooted in emotion rather than analysis. Another mechanism is the absorption of collective financial norms. These norms define what behaviors are considered acceptable, desirable, or expected. They influence spending patterns, investment styles, savings discipline, and risk preferences. When individuals absorb crowd-driven norms, they shift their financial behavior to match the emotional climate. These shifts occur subtly, often without conscious awareness, making them difficult to reverse. The cumulative impact of adopting crowd-driven financial norms is long-term misalignment between actions and personal goals. Crowd psychology also distorts the perception of stability. Stability in financial systems is never absolute. It is dynamic and contingent on underlying factors. But the crowd interprets stability emotionally. During optimistic periods, stability is overstated. During pessimistic periods, stability is understated. These misperceptions lead individuals to take actions inconsistent with the actual stability of their financial environment. Over time, these actions accumulate into patterns that contribute to instability. The most profound impact of crowd psychology lies in its ability to suppress independent thinking. Independent thinking requires clarity, distance, and the ability to evaluate information without emotional contamination. These qualities are difficult to maintain when individuals are embedded in environments saturated with emotional signals. The constant presence of crowd-driven sentiment gradually erodes these capabilities. Individuals become less reflective, more reactive, and more reliant on emotional cues. This erosion marks the transition from deliberate behavior to emotional mimicry. Breaking free from crowd psychology requires deliberate effort. It requires establishing internal financial principles that remain stable regardless of external emotional fluctuations. It requires developing awareness of emotional signals and learning to identify when emotions, not logic, are driving decisions. It requires the willingness to tolerate discomfort and the discipline to maintain long-term strategies when the crowd moves in a different direction. These skills do not eliminate uncertainty but create a framework for navigating it with clarity. Crowd psychology will always exert influence, but its impact varies depending on an individual's internal structure. Those who build stable internal frameworks, clear goals, disciplined habits, rational evaluation, and long-term thinking become less vulnerable to emotional contagion. They recognize the difference between collective emotion and financial reality. They develop the ability to observe crowd behavior without being absorbed by it. This separation allows them to act in alignment with long-term logic rather than short-term emotion. Ultimately, understanding crowd psychology is not about rejecting the crowd entirely. It is about recognizing when the crowd's emotional momentum diverges from financial fundamentals. It is about identifying moments when emotional waves are at their strongest, because these are often the moments when long-term opportunities or risks are most significant. It is about developing the internal clarity necessary to act intentionally rather than reactively. Crowd psychology remains the greatest enemy of personal finance because it replaces independent reasoning with emotional imitation. Its influence is silent, pervasive, and deeply rooted in human nature. But once individuals understand its mechanisms, they gain the ability to navigate financial environments with greater clarity, stability, and intention. Awareness transforms vulnerability into resilience. Thank you for spending your time here.